Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us right now for a brief, I believe she hasn't shut down, right?
No, she's
Henrietta
still
Treyz,
completely
Veda
engaged.
Partners, joins us as well. In the blur of all this, in the articles, the rumors, the gossip, Henrietta, what are you focused on today?
Good morning, guys. I really am focused on the two senators, Leader Thune and Leader Schumer. The reality is, of all the operators in D.C. right now, they're the only ones that actually have the physical requirement to be bipartisan. Leader Thune's going to need anywhere between 10 and 20 Democratic votes to keep his chamber open and the government open. And I think that means those two are the most important people in the room. I look forward to them getting together at some point.
Does Schumer have the Democrats behind him, or does he need to watch his back?
I mean, to the extent that Democrats can line up behind anybody right now, I think Schumer is moving forward, knowing that were he to divert course and just cave right now, that would be disastrous. So the base of the party is pushing him towards this shutdown. Same, especially with the House side. There's a real disparity between House and Senate staff right now, where House members are gung-ho on a shutdown and the senators are more hopeful that we can keep things open. But that's the usual dynamic. The House is a more rabble-rousey bunch.
Your odds right now are 70% that the government will shut down at midnight, September 30th. If that happens, Henrietta, is it worth ascribing blame to one party? Does any party care?
I think that we'll play the blame game. You can see the polling shows that Republicans are going to blame Democrats, Ds will blame Rs. Independents are relatively split, but the bottom line is the majority party is the Republican conference. They own the House, the Senate, and the White House. So shutting down is going to require bipartisanship out of the Senate. That means that the senators are the ones that are most important. I think Democrats are going to be really upset unless they get some sort of a concession. And this time, Schumer's illustrating that they're not going to fold the way that they usually do. And they're deciding that healthcare subsidies are really the fight to stand on right now. What's interesting to me is that they're not migrating to any of the broader issues with the Trump administration, especially the one that's most impactful in polling data to the American public, which is opposition to the tariffs. That is widespread. Inflation, prices, the economy are where Trump is now polling materially underwater, which is an about face from his election win. And I think that's something that the Democratic Party could very easily seize upon, but they're not doing that. They're focusing solely on healthcare.
So if we get a shutdown, is there expectation how long it may last? Is this going to be something that people are going to really feel?
Yeah, that's a good question. I would say as a former staffer, I know that you get paid every other Friday. And so there is a 750,000 person furlough announcement that's going to go out. And a lot of those folks are paid every other Friday. So it might sound trite, but for a lot of these members, these are their individual staffers. And if they're going to miss a pay cycle on Friday, October 10th, that becomes a problem, especially Saturday, Sunday, Monday, when they've now gone 3 days without a pay stub. And we're not high paid workers up on the Hill. So it's not just those guys, it's people across the country. You know, it's national.
Henrietta, this came up this weekend. Let me just ask it with great respect for your encyclopedic knowledge of Capitol Hill. Are we running a parliamentary government? Is it really Prime Minister Trump?
Yeah, I mean, I think the president, if and when we shut down, the difference here is that he has demonstrated a clear willingness to use his authority to any extreme that he can come up with. And Russ Vought is, reportedly having the time of his life right now. And I think the shutdown, the fact that Congress has ceded control and authority over taxation is wild. And indeed, the Trump administration even made the argument to the Supreme Court recently that by not voting to repeal the president's international economic emergency powers tariffs, they were actually giving him the authority to tariff or to tax the American public. And correct me if I'm wrong, but I'm pretty sure we fought the British over this one. So, yeah.
Yeah, it started in Brooklyn. Henrietta, give us some sense of admirals and generals flying in to meet. And I guess now the president's going to show up as well. Discuss.
It seems like a pretty good campaign video to me. My understanding is that it's going to be recorded. It's going to be, workshopped, photoshopped, cut,
so it's a
sliced,
photo op.
edited, and sent out.
I saw one report that said it's a photo op. You agree with that?
Yes.
All right. I guess. We'll pay attention.
I feel like Angry Beavers on Nickelodeon. This is nuts.
This is nuts.
Henrietta Treyz, thank you so much. Greatly appreciated. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Conversation of the day for those clipping coupons. James Caron, CIO, Cross Asset Solutions, Morgan Stanley. Okay, you walk in, you say, hey, stupid, look at the 5-year total return on bonds. I took a big index like bond fund, flat. But if you come in even 3 years, you get a legit 6.8% total return. Where are we going to be in 12 months if the marketing machine of Wall Street, not including Morgan Stanley, is going to be saying, OMG, bonds are great? Do we need to get out in front of that?
Bonds have always been great. So the coupon on bonds today, what people talk about as the all-in yield, is actually reasonably decent today. So you're getting about an investment grade credit. You're getting about a little bit more than a 5% yield if you put a portfolio together correctly. And if you pick the right bonds, you might actually get a little bit of total return on top of that. You could be getting somewhere around 6% returns. What's wrong with that in the investment grade credit space, right? If you add some high yield to that, you can even get a little bit more. So the bottom line is that we do think that default risks are going to be relatively low because we do not have a very strong view for a recession. We think recession probabilities are low. So we're happy to clip the all-in coupon yield, but people will argue that spreads are very tight, and they're right.
Spreads are tight, but they've been tight for a while here. And the best performer in U.S. fixed income has been U.S. high yield. Mm-hmm. So what does that say about, I guess, the market's wanting to take that credit risk?
So I always like to say that just because spreads are tight is not a reason for them to widen. There has to be a catalyst for these spreads to widen. Spreads are going to naturally tighten as long as there's not some bad news or a recession or some geopolitical event that comes through into the markets. But just because they're tight, they can stay tight for a long period of time. And I think sometimes that's what people mistake.
If they're tight, the yield of Caron garbage to the full faith and credit U.S., can the U.S. yields come down so that spreads indirectly widen?
So we would think that both happen at the same time as U.S. yields. They both come down, right? Okay. So I don't think there's a lot more room for spreads to tighten. And when we say spreads tightening, what we're meaning is that you're getting the additional total return out of your corporate bonds relative to U.S. Treasuries, what we call the excess return. We think that both are going to come down together. So I think within fixed income, what you're looking to get is the coupon these days.
Federal Reserve, they cut rates once here. How do you think the cadence is going to be here going forward for them?
So I think it's 2 more times this year. January is a possibility. I think we end with a Fed funds policy rate upper end of the band at 3.5%. I think there are a couple of things going on. It's beyond just an insurance cut for labor. I think some of it, too, is also to address liquidity concerns in the balance sheet. The Fed's balance sheet through quantitative tightening has been coming down quite a bit. It's about 6.6 trillion right now, which is low relative to the past few years. The overnight repo rates are actually starting to go up in price because bank reserves are starting to falter a bit. So if there is a shock event to the markets, you need to have these overnight rates lower. And I think that's partially the story here as well, not just the labor market.
Jim, what are your team? What are you guys seeing in terms of best value out there? Where do you see some value out there?
So within the fixed income space, we've been tilted.
New York Mets debt.
Yeah, cheap.
Within the fixed income space, we've been looking primarily at the high yield space and also bank loans. So bank loans it's almost like floating rate high yield. And in some ways, it's a shorter term reset on that. What I would say is that despite the fact that we think rates are coming down, we think that short term high yield credit, bank loans in particular, actually have more room to appreciate in price value over time as default risks stay relatively low. A lot of people like high yield. We do too. But we also like the bank loan debt. And we also like to barbell that by owning some short-term, high-quality government bonds too.
I don't want to get you in trouble, but there's just so much respect, Jim Caron, for your application of physics to our coupon market. Jim Caron on private credit and the liquidity premium. Help me here with the lockup that's going on in private equity, and particularly your world, private credit.
Yeah, so in the private credit space, this has been an area that's become, I'd say, a lot more democratized. So a lot more entrants have come in. So we have a lot of non-bank players in the markets right now trying to accumulate a lot of these assets to basically create funds so that people can invest in these things. This has created a bit of an overcrowding in that space.
Like a bit of a 2005 overcrowding?
I wouldn't necessarily say a 2005 overcrowding, but it is basically the valuations, I think, at this point are getting a little bit stretched. So you do have to be very specific and very particular and be very picky about what you're putting into your private credit portfolios.
If your people and the rocket scientists working with you, they're all out of Caltech. You only hire well, Harvey Mudd, he's got some token Harvey Mudd guys as well. Good morning, West Coast, listening early morning. So you do a tranche analysis. I'm going to go to David Goldman, the giant at Bank of America years ago. On the private credit tranches, is the risk the garbage, or is the real risk the premium tranches where they come down 5 points?
So it's a really good question because you get the yield by owning the lower quality credit stuff, what you refer to as garbage.
It's French.
And it's French. But you also need to balance that with some of the higher quality. The higher quality credit stuff is actually really good. I mean, that's actually very, very solid. So you are taking the risk on the lower quality credit, but you're not going to get the yield that's attractive for people to buy unless you have some of that. So it's really about managing that portfolio and doing the bottoms-up analysis on every individual company that you're putting in. Mm-hmm. So private credit is a broad term, but per manager, per fund, that's what we have to talk about. And that's what we have to be very, very idiosyncratic when we think about this.
Brilliant. Jim Caron, thank you so much. He's the Morgan Stanley Investment Cross-Asset Solutions with some terse comments there. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Laura Calvasina joins us right now. Thrilled she could be with us today on this booming equity market. Laura, lots of back and forth here. As you write for RBC Capital Markets, what is the distinction of the debate right now on owning equities?
Well, thanks for having me, Tom. Look, I think that, I probably have the best color for you this morning from what folks in the UK are thinking. That's where I spent last week. And there was, sort of a discussion about funds flows, right? And if you want to sort of fade the US, where do you go? And what I told folks was that if you look at the EPFR data, what we're seeing very clearly is that there's kind of a lack of conviction on what the alternatives are. So whether you're looking at LATAM or China or Japan, or even Europe, frankly, you've had all these sort of attempts for flows to turn positive, and then they tend to peter out. The European ones and the German ones lasted longer than everything else. What's funny to me, too, is if you look at the global ex-US category, that's had the best flows this year over the last, say 6 months or so. But even that looks like it's starting to fade. So what we see is just sort of a real kind of lack of conviction on exactly where to focus geographically.
So that trade we saw early in the year to rest of world, has that in fact faded, do you think? So
if you look, we have one chart in our weekly, and we tend to put the weekly out on Mondays, and we look at U.S. relative to non-U.S. on the MSCI data, and it's just been tracking, sort of sideways over the last few months. There's been a little bit of strength in the U.S. recently. Mm-hmm. I think what's interesting is that global ex-U.S. trade, even there, the flows have been faltering. I mean, it's a time of year when seasonally equities tend to be weak. And we actually did a seasonality of funds flow data earlier this year, and you tend to see the flows fade at this point as well. So maybe this is just a market, frankly, that's getting a little bit tired.
Our friends in the UK and London, are they concerned about valuations here in this U.S. market?
Yeah, and I would say, the number one question that I felt like I heard from people is just kind of what's sentiment like in the U.S.? People just kind of wanted to know what investors are thinking over here and, kind of how that compared. By the end of the week, I got a good sense of that, which is the UK investors seem to be a bit more cautious than the US investors. But I would say number one issue people were proactively bringing up was valuation. And my UK clients are fantastic macro thinkers, so this is not a knock on them, but there was kind of no one specific thing beyond that they were pointing at. It was just things seem really elevated, things seem really high, was kind of how the conversation started.
Are there certain sectors that when you go over to the UK or Europe that your clients want to speak about, whether it's tech or financials or health? I mean, is there certain sectors they want to focus on?
It's funny, Paul. Usually financials, but I can't even remember one meeting where the clients proactively brought it up.
Okay.
I think I took it there eventually because it's a sector I like. Normally, I would say as a general rule, it's always tech, it's always consumer, and healthcare often tends to be in focus as well. I think for technology, it just has to do with where the global opportunity set sits. So that's a big part of it. Obviously, tech is a big sort of workhorse, but healthcare was really in focus last week.
I'm talking from a technical analyst standpoint, is a fundamental type. What is your setup where you say, I have to get off this bull market? It's not Fed chat. I'm pretty negative on that. Is it like earnings miss?
I think earnings is huge. I do think if you related to earnings is the fundamental economic backdrop, whereas if you look at, that's a feeder, right? Revenues really matter a great deal for earnings.
This is the second time, let's stop there. This is the second time we've heard this in like 6 days. How do you analyze revenue dynamics starting with JP Morgan October 14th?
So, I can't say on that company specifically, but when I do sort of my modeling, Tom, and in my earnings model, the revenue line is very much a quant-driven model. So we have kind of 5 different components. Yeah. And with revenues, the 2 most impactful macro variables are GDP and CPI. And so we're looking at real GDP and then CPI. We break them out separately. And both of those, if you take the assumptions up, it's going to goose your revenue number.
I mean, I can't emphasize, folks, what you just heard there, how important it is. This goes back to Tom Galvin at DLJ, and I'm sure Tom would say people before him. But it's one of the first things I did when I came to Bloomberg. Revenue analysis is really important. Susie Welch, with that essay in the Wall Street Journal, her former husband, Jack Welch, was brilliant on unit price dynamics of revenue. Paul?
So, Lori, Tom and I have been talking about it this morning. We might have a government shutdown tomorrow night at 12:01 a.m. What does that mean historically for markets?
So it's interesting. I did run over the weekend. I looked at the betting market data on, I think it's WSL Predict that you guys all run. And it's this great little widget. You can go and see what betting markets are pricing on all these, kind of stock market sensitive issues. And I noticed that the betting market data was starting to reflect higher probability of a shutdown last week, right around when the market was wobbling. Now, I don't want you to over extrapolate there. I didn't get a single question from clients on it last week. I got a question from one trader. And some of us macro folks at RBC have been writing about it, right? Because it is in the headlines a bit. This is a really, really tough thing to analyze and parse out exactly how it's impacted stocks in the past. If you just look at when the government's actually been shut and what stocks have done, the 2 words you want to remember are mixed and mild. In the 70s, they tended to go down, more recently up, but it's been very mild overall.
Lori, thank you so much. Greatly appreciate it. Did you get to Harrods in London?
I didn't make it there.
You didn't make
no
it
fun. I was just working the whole time and went to sleep early.
I've done that. There's like Heathrow, hotel, work, hotel, pub, Heathrow. Pub. And they go, how was London? What did you love? And I'm like, Heathrow, hotel, work.
The client lunches were the highlight because then I actually got to have, local food.
Did you have full English breakfast? Come on.
No, my hotel had a really nice buffet though, but I had peas at lunch and I had some fish and chips.
You have to smash them with your knife.
Yeah.
Yep.
Very good. Lori Calvasina, thank you so much. Greatly appreciate it. With RBC. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The newspapers with Lisa Mateo. What do you got this morning, Lisa?
Okay, this one's in the Wall Street Journal. It has a look into credit markets, which it says is running hot, but they're saying that some on Wall Street say it's too hot. I mean, this is something you've talked with a lot of guests on the show about. They say Wall Street's on edge. Any bad news is kind of touching a nerve. They gave the example example of kind of what's triggering some conversations about bond investors, analysts. They talked about the 2 sudden bankruptcies in the auto world. You have one of a lender, the other auto parts supplier. They say so far there's no sign of this bigger fallout, but when you combine that with other challenges like persistent inflation, rising defaults, and private credit, which is huge, it's kind of making them take a step back. So it has this whole look into it.
I don't know, but the new issue market has been just ripping the last few weeks. Companies raising capital all over the place. So I think if you're a good credit, I mean, the market.
We get the First Brands news over the weekend, which I'm not up to speed on, but nevertheless, there's these little. To Lisa's point, there are these little
data points
out there, little data points. I like data points. Next,
okay, so Hollywood studios, right? They know the power of online creators. We've heard different stories about that. But Bloomberg Screen Time, they actually take a look into why only a few of them on YouTube, these creators, are really having success, raising money, selling projects to streaming services. Lucas Shaw. So he kind of gets into it. I mean, you have like Amazon, Netflix, Disney. They've licensed shows that live on YouTube, like Miss Rachel and Coco Melon. But there's some creators who are just having a hard time. So he kind of digs into it. He's saying there's this disconnect between traditional financial institutions, this new breed of digital media companies, a few YouTube channels. They built companies with real scale. He says a lot of the times it's problems with valuation, and that's why they can't get the money they need. But it was this really kind of deep dive into it as to why they can't, sell.
It's interesting. I mean, Lucas wrote this Bloomberg Business Week cover story last week about Mr. Beast, the biggest YouTube star in the world. He gets more than 250 million views on every video, but his company lost more than $100 million last year. So. Yeah, I don't know.
His show lost a lot of money, but
so I don't know how that all works.
Exactly. That's kind of what it gets into, which is pretty interesting. And then finally, we have some big news here in Times Square. Something big is coming. Okay, it's not the casino. No, we know that's not happening. It's Labubu owner Pop Mart is coming to Times Square. Yes, this is according to the New York Post.
So instead of the ball coming down New Year's Eve,
it'll be a big Labubu head. A 10-year lease for a 7,000 square foot store, 1540 the Broadway. Broadway and 44th. Expected to open 2026 in the second half, but it's a big building. Disney stores in there, Forever 21, U.S. Polo Association's in there. So it's just going to show how big this brand is becoming.
Are all the dolls creepy, or can there be nice Labubu?
They're all kind of like creepy, like little monster toothy dolls. But the celebrities love them, and that's what makes the kids want to get them. And they've been
I see them
doing
on
very
bags.
good for them. They go in the very expensive bags. So yes.
No, thank you.
We had one floating around the house. Vet Bill was chewing on it at one point.
You better not. They're worth a lot of money.
Well, they're still like going. I mean, they're still popular and all that.
They're still. I mean, they pushed. Pop Marks. They surged 213% this year over 2024. So it's a big push for them.
Right.
They started to slow back a little, but I mean, if a store comes to Times Square, people are going to come.
Lisa Mateo, thanks so much. It is a newspaper. It's hugely popular.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.